Hey everybody, we are picking back up with my series Understanding Financing, and today we're going to be talking about the various loan products that most buyers are using in the purchase of their real estate. Obviously, there are a lot of loans with various criteria to qualify for each and different requirements from different lenders. So my goal today is just to give you the basics so that you feel confident in having that initial conversation with your lender. They're the ones who are going to be able to help you choose which product is the best for you in your situation to meet your goals. So let's get started with the first point, fixed rate versus adjustable rate mortgages. A fixed rate mortgage is just what it sounds like. You have a fixed rate and a fixed monthly payment for the entire length of the loan. A lot of buyers like this because it's very predictable. They know how much money they have to pay towards their mortgage for the entire length of their loan. So there are adjustable rate mortgages and hybrid versions of an adjustable rate mortgage. Let's say you get an ARM, an adjustable rate mortgage, that has a fixed introductory period but an adjustable rate after that. This is called a hybrid ARM. What this means is you may have an introductory period of time where your interest rate is going to be fixed. That could be 5, 7, 10 years. And then after that, your mortgage rate will adjust. I think most people have heard of a 5-1 ARM. So what is that? That is an example of this hybrid where you have a 5-year introductory period. After that, your rate can adjust once per year for the lifetime of the loan. Why do buyers like ARMs? Well, because in the beginning, that introductory rate is going to be lower, which may mean a lower mortgage payment for you in the beginning. Now, take into consideration your rate may go up after this introductory period expires. That's going to make your mortgage payments go up, and so you want to take into consideration, do you think you're going to be able to afford the costs that will come in the future? So talk to your lender for all the details about that. All right, next we are turning to conventional loans versus government-insured loans. A conventional loan is one that is not insured by the federal government. There are several different types of this: conforming loans, non-conforming loans, jumbo loans, and there's also portfolio loans where the lender is keeping that loan on their books. There are two main types of government-insured loans, and we're going to be talking about those today: the FHA loan and the VA loan. An FHA loan is insured by the government. That basically means that the government is insuring losses that the lender may have due to a buyer defaulting. Now, the great thing about FHA loans is they have some low down payment options, including 3 and 3.5% down payments. Now, keep in mind, you will have to pay mortgage insurance, and that is going to be an extra fee every month. And talk to your lender for all the details, see if an FHA loan is a good fit for you. The other option we have here is a VA loan. Now, this is very similar in the sense that it's insured, but this time it's by the U.S. Department of Veterans Affairs. You have to be either current or former military or the spouse or surviving member of someone from the military. What is the reason why people love VA loans? 100% financing. That means 0 down payment. So obviously you can see there's a big incentive to do that. Now, there are other fees and things to take into consideration, so talk to your lender about those. So the last category you need to understand is a little bit of a breakdown on one of our conventional loans here. What is a conforming loan versus a jumbo loan? Now, a conforming loan is one that conforms to the guidelines set by Fannie Mae and Freddie Mac. They have a maximum loan limit, and for 2017, they've set that number at $424,100. Now, in areas where the median home price is higher than the average, such as ours, the number is a little bit higher. So for 2017, for the DC metro area, that maximum loan limit is $636,150. Now, a jumbo loan is anything that doesn't conform to that standard, aka is a bigger loan than the $636,150. Now, because this is more money, it's more risky, it is going to be harder for you to get it in terms of criteria. It may be a higher interest rate, you may need to have reserves on file, and you may need to have a larger down payment. So check in with your lender and talk to them to see what your options are and what you need. I hope that this has been a good summary of all of the basics. Next week, I am really excited because Rich Godbout of Caliber Home Loans is coming, and he's going to be talking to you about why you should get pre-approved and what forms you're going to need to bring with you in order to get pre-approved. So stay tuned for next week.